All right, folks, and welcome to our Apple stock analysis workshop. Like in our usual process, we're really going to give you a deep dive into Apple. We're going to review the stock, how it has performed, look at trading multiples as part of our due diligence process, and just give you more insight into what professional analysts on Wall Street look at when they're trying to answer the question, is the stock a buy? Is the stock a sell? Or should we avoid? I have here on my screen topics that we're going to cover in terms of an agenda so that we can make the most out of our time. In terms of, point number 3 would be analyst education, which is what we are illustrating and teaching students in our programs. And point number 4, this is the first time that I'm actually illustrating this, Romero mentoring, why? What's our why? And many of you that are in our program, you have direct access to me and you get the opportunity to speak to me on an individual one-on-one basis. But one thing that I would like for you to really understand is really where we are coming from. Why are we doing what we do? And a lot of it really comes down through my own philosophy and worldview. Myself, I was a philosophy minor. And this is me asking myself, why do I do the things that I do? What drives me? What helps me get up out of bed every morning to really make a difference? And it really comes down to using education, using the knowledge that I've acquired, all of the professional skill set, and deliver it in a content format to make the world a better place. Now, what does that mean? Well, number 1, we want to improve financial literacy. We're going above the surface level of finance. Typically, how do you open a bank account? What's the difference between a debit or a credit, and so forth? I mean, we're going into the highly technical skill set that perhaps 90% of people don't even understand because it's very technical, and in some cases, it's very time consuming to understand this skill set. And number 2, with this skill set and that education, you can improve income inequality. For example, the average starting salary of a student in our program is 6 figures. Compare that to the national average of around $58,000 for an undergrad coming straight out of college. Our students are making, in some cases, more than double that amount. So with our educational analyst program, we're helping solve those 2 problems that I've illustrated right here on my screen. And that's really my why. Okay, so I hope you guys understand that. I hope it resonates with you. So with that, let's dive into the actual content that we have here. Okay, so number 1, I want to give you a very high level overview on understanding the cycles of the stock market, understanding the cycles of how stocks actually behave and move. And these cycles don't happen overnight. They don't happen within a week time frame. I'm talking about multi-year cycles where you're looking at an industry, you're looking at a stock within 3, 4, 5-year periods. And in some cases, like an institutional investor that would look at it from a decade-long standpoint. And when you look at these cycles, to better help us understand, you need to break it down into parts, right? Every stock, goes through a boom and bust cycle. Are you buying at the top? Or are you buying right at the beginning of a major trend? But what is the underpinning? What is the story? What is happening underneath the hood? What is happening with all of the market participants? This is very important. What is the consensus of all investors, aka market participants, that are looking at an individual stock or an entire industry or the broader stock market as an asset class? So in phase 1, we categorize it as the accumulation phase. Typically, low media coverage, not many analysts covering the stock. Early investors come in and they're really anticipating positive news. That could be earnings. That could be a drug. That could be the result of a new technology or a product that the company is creating, right? This is usually phase 1, before all of the hype, before all of the noise and the media begins to promote the stock. Phase 2 is essentially the confirmation phase. So investors that were in phase 1, they get their confirmation, positive earnings, whatever piece of news or catalyst they were anticipating materializes. Now they get favorable confirmation to start adding shares. Then in phase 3, the media takes a hold of the stock. This is where you get CNBC, Bloomberg, the Wall Street Journal, the New York Times, all of the major media outlets begin to cover the story. And with that comes new market participants, new capital, new money on the table to pump the stock higher, especially if it actually has a solid foundation with strong financials. What do I mean by that? Is the company growing revenue over 20% over the next 5 or 10 years? Is the company profitable? Is the company earnings per share positive and also growing at a double-digit rate? And are those earnings sustainable? Key word here, are the earnings and cash flows of the business sustainable? Very important. And then in phase 4, this is where you get the public mania, right? The stock is up 100%. Many retail investors start to take notice. They go to Twitter, they go into Wall Street Bets, the whole hype and motion, and everyone starts buying at the top. And then before you know it, investors in phase 1 or 2, they're selling to you over here. These guys are cashing in and taking profit. And then the stocks decline 90%, like we just experienced in the most recent market bubble that just burst. And who's usually holding the bag? Retail investors. So hopefully, for those of you that are part of our analyst prep program, in our community, you understand this cycle and you're not the one buying up here, okay? We're going over and over these cycles so that you understand it and you can recognize those patterns when you see it. You're not going to recognize this overnight. It's going to take time. You need to see multiple market cycles and study hundreds of scenarios to really understand what I'm trying to present here, okay? Now, let's look at Apple and let's look at the competition, right? Where is Apple currently trading at, right? So we're looking at trading multiples. This is something that we cover in module number 2, comparable company analysis. Remember, we are paying close attention to 3 multiples over here: revenue, Ebitda, and PE. From an investment banker standpoint, when you're going to buy or sell a company, we care about revenue and Ebitda multiples, right? Because if we're buying and selling a company, at what multiple are you buying it? Typically, they're referring to Ebitda or revenue, okay? Now, look at Apple. How is Apple trading relative to its peer? And I'm judging by the mean and median. Is Apple trading above the peer group or below the peer group when we're looking at 3 metrics or 3 multiple variables? On a sales basis, Apple's trading above the mean and median, right? So you might suggest that they're trading at a premium. Why is that? Key question here. Why is that? Look at an Ebitda multiple basis. Apple is also trading at a premium to its peer group. And the same thing on a PE basis. So why is Apple trading at a premium? For those of you that are in the analyst prep program, this is a perfect example that you can use during an interview. And if you are across an investment banker and they're asking you this question, type in your answer right now. For those of you that have access to typing questions or responding, what do you guys think? Why is Apple trading at a premium to its peer group? And mind you, when you're looking at the product or service category of Apple, I've illustrated that information right here on row 11 and row 12. From a product category, they have their Mac, their iPhone, their iPad, wearables, home and accessory products. And then from a service category, they have advertising, Apple Care, cloud service, digital content, and payment services. Okay. Now the question still stands. Why is Apple trading at a premium than its peer group? Some investors might say that Apple is overvalued. Okay. Some investors might say that they're trading at a premium because they're best of breed. They're probably one of the best, most successful companies in history. Therefore, they deserve a premium. But here's the other metric or financial piece of information that I like to look at and that other many professionals will also take into consideration, which is, now here's a short break. If you're enjoying our content, don't forget to visit our website, romeromentoring.com, and check out our starter analyst programs where you'll learn financial modeling, investment analysis, valuation, and develop the skills professional analysts apply on the job each day. In addition to that, you'll have access to our platform and exclusive access to content relating to investing, stock analysis, opinion, and much more. Join our growing analyst community and level up your skills today. Now back to our content. The profitability of the company and how fast they're expected to grow their bottom line, in this case, net income, over the next 12 months. Okay, so let's take a look at gross profit margin, okay, Ebitda margin, and EBIT margin. So on a gross margin basis, they're trading below the industry average. Okay, fine. On an Ebitda basis, which, by the way, out of these three metrics, I will focus more on Ebitda because it is a proxy for cash flow. It is an approximation for how much, keyword here, operating cash flow the business is generating. And that is very, very important. And you could see that they are generating on an Ebitda margin basis, 34% versus this peer group of 25%. So they're actually more, I guess you would say, efficient on an Ebitda margin basis, which means that per every dollar of revenue that comes in, they're generating about 34 cents in operating cash flow, whereas its peer group is generating 25 cents. So for that level of efficiency, okay, or that premium in Ebitda margin, the market is paying a premium for this business. And you're seeing it, how it plays out in the numbers. Folks, this is part of understanding the story behind the numbers. Many investment bankers at a high level, this could be the VP, the director, or the managing director, it's part of their job to tell this story to their clients, exactly how I'm explaining it to you. But we can go layers deeper. We can understand the demographics of the industry. We can go deeper into understanding all of the products and the metrics of the industry and the competition to perhaps sell a story if the company's trying to raise equity or debt. That's a whole different perspective when you're thinking about what the role of an investment banker is. But right now, we are thinking from an investor standpoint. We have our investment analyst hat on. And when we're looking at their margins, now we understand why they're trading at a premium, okay? Look at EBIT, okay? 31% EBIT margin, whereas the rest of the industry, mean and medium, 18%. Therefore, they deserve a premium. It's best of breed. You know, it's a great company. And this is, I mean, you know, when you go deeper underneath the hood and you look at the balance sheet of Apple, what they've created, it's a money-making machine where they collect cash first. In other words, they collect cash today. And all of their suppliers, all of their creditors, okay, they get to pay them 30 or 60 days later. So think about that, right? You collect money today. With that money, you could invest it, collect an interest income or a rate of return on that money over the next 30 or 60 days, then take the interest income and pay your suppliers, pay your creditors, pay your employees. It's a cash surplus from a working capital standpoint that Apple has generated. Again, they are just printing money. It is a money-making machine. That's why the market is paying a premium for this stock. And look at the, let's see here. Do we have it? It's not being shown on this table, but as you're going to see in the upcoming tabs that we've illustrated down here, you're going to see the enterprise value of Apple. I believe right now it's over $1.5 trillion of enterprise value. That is significant. So I hope you can understand how we interpret and read comps. This is very, very important. You can apply this skill set, not just to company. Now, here's where financial literacy and understanding this skill set, how they apply it in the real world. If you're going to buy a house, list all of the properties that you're looking to buy. List all of the metrics of those properties, and then compare to your target property. That's comparable analysis. If you're going to buy a car, same thing. Put the model of the car, the mileage, the listing price, and it'll give you an idea or a rough estimate on what the true value of that car is. So understanding comparable company analysis has an enormous and effective application in many areas of our lives. This is where I keep saying The skill set that you develop in our analyst program are transferable to everyday life. These are lifelong skills. Okay, so I don't want to deviate too much from the topic, but now I hope you understand why Apple is trading at a premium. And we are going to use these numbers later, specifically revenue multiple, to come up with an implied price target to determine is a stock undervalued or overvalued. Okay, now the next thing I want to do before I continue to the next slide is take a look at the chart of Apple, right? Because I always want to see how the stock has performed and is it up year to date or not, right? We're taking here a very long-term view. Let's look at the last 12 months. Here we go. And you can see that starting in 2022, right? We're way up here. The stock is essentially down. So it's trading below its opening price year to date, right? We can basically say that this stock is down maybe roughly 20% in 2022 year to date. Now, why is it down 20%? Well, of course, you are in a rising interest rate environment. You have fears of an economic slowdown. You have inflation risk. You have geopolitical risk with the war between Russia and Ukraine, which can spill over into other parts of the global macro trade. In addition to that, you have sovereign risk from the credit side. Emerging economies, they are starting to have credit risk. Just take a look at Sri Lanka. Look at this geopolitical situation there and how that is affecting the bond market. So there's pockets of risk in the global economy that as market participants, we need to be aware of. If you're new to this, don't worry too much about it. I am giving you language that perhaps you can go and Google and understand yourself just to accelerate your learning and your own development. But at least now you perhaps may understand or have a little bit of context why Apple is down approximately 20% from the beginning of January, okay? And the question is this a good time to buy Apple or not? I mean, what do you guys think, right? I'm going to ask you, what do you think? Do you think Apple is going to continue moving higher from here, or do you think it's going to go and move lower? I mean, what's the consensus amongst all of you that are part of this workshop? Type in your question, type in your response. Up or down, buy or sell. This is kind of my way of me conducting a poll and testing or gauging our own sentiment here within this workshop. Okay, I see some of you are saying sell, buy, not sure. Okay, interesting. Okay. All right, well, we have to perform our own analysis in order to answer that question. You always want to run your own analysis and have data to support your own decisions and conclusions. So with that, let's revert back to our spreadsheet and let's continue moving forward. So let's also take a look at the financial performance of Apple, right? I always like to see financial performance because show me the money, show me the numbers. That's what we care about. We care about results. A simple way to explain what this income statement illustrates is essentially a report card, right? Every quarter, every year, a company has to report if they are public, meaning they have a stock. By law, SEC regulation demands them to report quarterly and annual financial results. So to us as investors, this is a report card. So let's go back to 2018, right? Look at Apple. They reported $265 billion in revenue. Year-over-year growth was 15.9%. The following year, declined 2%. The following year, up 5.5%. The following year, up 33%. And don't forget that during this period, we had COVID. On an LTM basis, revenue is still up double digits. Revenue growth is declining now. 2022, 2023, and 2024, look at the revenue. It's up, but is declining. The rate of revenue growth, the acceleration is decreasing. So the question is, will the market or you as an individual investor, Will you pay a higher multiple for Apple, giving that their growth rate is single digits, than what you did in the last, let's say, 24 months or 18 months, when they grew in 2021, 33%, and in the last 12 months, they grew 18%, right? The multiple that you would have paid 24 months, I can tell you, it's not going to be the same multiple that you're going to pay in the future going forward, because the rate of revenue has decreased. Very, very important. Now, let's take a look at Ebitda, because this is another important metric that I care about, right? Look at 2018, 30.8%. Then it declined again. Then it recovered with revenue growth. You can see how those two closely tied together. Okay, still maintaining 33.8. And okay, at least they're maintaining it, but Ebitda margin is expected to decline. Not that much. It's a few basis points, but they're managing to maintain their Ebitda of 33 and 32%, while revenue growth is declining below 10%, or let's say below, it's at a single digit rate. So again, this continues to prove that from an operational standpoint, Apple, best of breed. They are efficient in running their business. And this is what Wall Street estimates are essentially reporting. You know, these estimates right here, they're coming from perhaps all of the investment banks and research houses that cover Apple. And these numbers are essentially the mean. It's perhaps the average of all of the analysts that cover Apple. So I do take these numbers into high regard when I'm looking at them, okay? Another number that's important here is the net income. You can see how fast it's growing, okay? And actually the margin. And then, of course, earnings per share, the level of growth on an earnings basis. Wow, look at this. It's single digits. Single digits. So how do I summarize the financial picture of Apple going forward? And remember, the stock market is forward-looking. It's looking 6 to 12 months ahead, and we're discounting all of the risk. So the way I will summarize this is that from an operating standpoint, they're very efficient, maintaining their Ebitda margin of 32% and higher over the next 3 years. It's a positive. However, on the top line, revenue growth is declining. It's single digits. I am not going to pay perhaps a double-digit sales multiple for a company that is not growing at least 20% revenue growth year over year in the tech space. This is known as a mature company. So Apple, essentially, it's a mature story, right? And they just continue to service their customer base if they can expand it, maybe with new product offerings, with a new technology, whatever the case may be. But this is essentially, you know, it's a mature story. It's probably one of the best well-known brands in the world. So if you want to have exposure to the technology sector and the growth in that industry, I mean, Apple is emblematic of the NASDAQ, right? This is one of the most heavily weighted stock on the S&P 500 and the QQQs, which is the NASDAQ. So this essentially just mimics the tech sector or our economy, okay? So I hope that kind of gives you a high-level overview on how I will summarize the financial profile of Apple going forward. Now, where are we from a trading multiple standpoint? That's another key important piece of information, right? Remember in comps, revenue, Ebitda, and PE, right? This is where currently the company is trading at on a sales and Ebitda basis. But if we think about it from a historical standpoint, over the last 10 years, how has Apple's sales and Ebitda multiple been? Well, that's what I have right here in the next tab. We have revenue multiples, and right next to the right, we have Ebitda multiple. So let's first look at revenue. And again, folks, this is part of my process. I'm actually showcasing what my process looks like, what many investment analysts at top level hedge funds are looking at to help them make an educated or highly calculated investment decision, okay? Now, here's Apple on a sales basis. Right now, they're trading at 6 times enterprise value over Ebitda. Okay. Look at the high. It's 8.5, which happened right at the end of right around Q2 or Q3 of last year, or maybe 2020, right at the peak of the previous bubble. All right. So now imagine who bought up here. Like I said, from the stock face model, typically retail, first-time market participants that don't really have a decade of experience understanding market cycles. This is why a lot of people that come in late to the market, they experience pain when they're buying at the top, and then you are stuck in a bearish downward market that can last 12 or 24 months. And it shakes out a lot of people, especially first-time market participants, and they don't come back. So you have to train yourself, and you have to get the right information so that that doesn't happen to you. Okay. Now, before the bubble, look where Apple sales multiple on a median basis is. It's about 3x, right? If we round up, 2.9 to be exact, but we can say 3 times. Remember from our previous workshop, I said that there's typically a investing strategy known as reversion to the mean or mean reversion, where the multiple will essentially at some point come right back down to its median. The prudent thing to do, if you are a fundamental-based investor, if you adopt, let's say, for example, Warren Buffett investment philosophy, you will probably wait for the stock to come right back down to its long-term sales multiple median, right? And then maybe you can buy some shares, right? Once it's trading below the sales multiple median, maybe hold it for the next 5 years or maybe a decade and ride the next wave to the upside, right? That's the big question, right? How long is it going to be before Apple, one, comes down to its medium sales multiple, its historical sales multiple, and two, how long before we experience the next wave or next market cycle? I'll give you a hint. A lot of it is going to be dependent on the Fed, what the Fed decides to do. And it's also dependent on whichever new administration will be sitting in the White House. Because politics and the administration, in many cases, does dictate what sectors of the economy would win or will lose based on favorable tax and policies that could be favorable to that industry. Very important to understand those market cycles, okay? So understanding this, you now see that Apple stock, it could continue moving higher, maybe come back to its all-time high on a sales multiple basis, or you can wait. You can sit on the sidelines. You can wait for this stock to maybe come down to maybe 3 times sales multiple and give you a really good opportunity to buy it, to buy perhaps the most profitable, one of the most profitable companies in history, and then capture the next move to the upside. But time will tell. And one of the key components of being a successful investor is patience. Patience. Let me say that again. Patience. Okay. What about Ebitda? Another important multiple, right? Almost mirrors sales multiple trend, right? And the same story, right? The multiple right now is around 15.8. Historically, the median, it's around 8.9, right? We could round this to 9x. And the question that you should be asking yourself, do you want to buy right here now? Or would you rather wait for the stock to come down to its historical mean, EBITDA multiple, to give an opportunity to buy it again, right? Imagine the people that bought down here. Imagine the people that bought down here and had a longer term time horizon of 5 or 10 years. Those guys probably sold to you over here or so maybe up here, right? So you have to understand these market cycles. And I hope this kind of gives you context into how professional market participants are looking at Apple. It's not just the stock price. You have to look at the multiples. You have to look at metrics, and you have to understand the US economy, but also the global economy. What's the situation? What is the sentiment in the overall market? If you really want to be successful and be part of this game in the long run as well. Okay. So I hope this kind of gives you a big picture overview on where the stock is trading at from a multiple standpoint, sales and EBITDA. Okay. Now with that, here is an example of how we take this information to come up with a price target. What I'm illustrating right here, this is what an analyst, and well, actually one of our student analysts in our program put together. So her valuation range after performing trading multiple analysis up here on an Ebitda basis, and she also did a perpetuity basis. This is the DCF analysis. This was her valuation range. And then she ran multiple trading analysis or trading multiple valuation on a sales and Ebitda basis. And this is the price target that she received, that she arrived to. Here's the different scenarios and her price target. So at the time that she did this is back, I believe, earlier this year, the stock was trading at 158. So it was in line her valuation range, okay? Typically, what I like to do for myself and students in the program is, look, if the stock comes below your value, your low-end valuation range of 119, then that could be an opportunity for you to buy some stock because it's undervalued by the market. And typically, it could be for a couple of reasons. Maybe a bad earnings report, right, for that quarter. Maybe supply chain disruption, something that it's outside of the company's control. Maybe it's geopolitical risk, for example, what's happening with Ukraine and Russia. It could be interest rate risk, right? Higher interest rate. And if you understand the entire risk that the market is pricing, you can actually adjust your discount rate when you're doing your model and determine if this is a good time to buy, right? And look, you're in the probability business, right? You're not going to be exact. This is why you're running multiple scenarios. And you have to be very objective and calculated when you're making investment decisions for yourself. And for those of you that want to work in the industry, in investment banking, then maybe later work at a hedge fund, you have to train your mind to think in probabilities, in terms of probabilities, and assess risk and be able to project what the market and the stock might look like 6, 12, and maybe 24 months from now. It's very hard to adapt that framework of thinking because in academia, they don't teach you that, right? When you're in a classroom setting, it's more about memorizing theories or memorizing a formula to get the right answer or to arrive to the right answer. But in the real world, when we are market participants, you have to change your mindset and say and understand that even though you apply the correct formula, apply the correct process, you could still be wrong. Can you live in that environment where you do a lot of work and your work is neat, your work is correct, but you could still be wrong and you could still lose money? If you could handle that, then maybe personally, your personality profile, the way you are, maybe you could be a great talent fit to be in a hedge fund. If not, maybe you could be working within strategic or advisory in an investment bank, at a private equity firm where you're actually buying private companies and helping them improve and grow, or maybe go into venture capital. So there's many different areas within our financial systems that you can go and apply your talents and skill set. But first, understand your personality and what's your why. Very important, understand your why, okay? So I'm just giving you here an example of how you can apply all of the valuation methodologies up here to kind of give you a reference point if the stock is overvalued or undervalued. And this is coming from one of our student analysts in our program. She put this together. And as it stands, the stock is basically fairly valued, right? It's trading between the high and the low. If the stock was trading below 119, which by the way, it kind of did, it got close to this earlier this year. Where? Let me put the chart, the stock chart right next to it. All right, let me zoom out a little bit so that we can put both things into perspective. And let's change this to a weekly time frame. Let's minimize it. Let's zoom in right here and there. There it is, okay? you can see that earlier this year, the stock, if we draw 119, will probably be from here to 216 all the way up here. It got close to it, right? Not necessarily all the way, right? Probably a low print of 128, but you already have your high and your low. If the stock is near the low, then it's probably a buying opportunity, okay? And if you buy around the low, then chances are that it can potentially come to your high valuation range of 216, and that will be your price target point where you could probably peel some off. Okay, so I'm just putting things into perspective so that you can understand how you can take the technical analysis valuation methodologies and apply it in real time. So with, having seen this, is this the low? Is this probably the low for Apple? Well, I have to do my own valuation now. So the next step is to perform preliminary valuation, right? And I'm using sales multiples right here. So let's go through this exercise quickly, like we've done in previous workshops. And I'm doing this also myself for the first time to uncover a little bit more of what the stock valuation should be. So I'm going to take my historical financials from 2019, okay, all the way to 2021. I want to see those, have them into perspective. And I'm also going to link my future estimates for revenue. Here it is, September 2022. Wow, I mean, $393 billion of revenue. I mean, guys, wrap your head around it. This is bigger than some countries' GDP. Like, wrap your head around that. How many iPhones, how many iMacs, how many wearable devices are they selling in order to generate close to $400 billion in revenue? Let that sink in. All right, let me calculate here. Year-over-year revenue growth, very important because we use year-over-year revenue growth to dictate what our sales multiple will be on this business, okay? Now, what is the stock price? I'm just gonna link this to my comp table. Here it is, 150. And what is going to be my multiple? Okay, so the multiple that I am going to choose right now, based on the current scenario or the current multiple that the company has, that will be my base case right here, row 5, right? Notice here that I have different cases so that we can come up with different price targets. So the base case, the bear case, and the bull case. The base case will be the current scenario or the current multiple that the market is paying for this business. So I'm going to link this to my comp, and here's the multiple, 6.1, right? Now look at the bear case. The bear case, I'm discounting it by 20%. So it's 20% less the base case. This is assuming a recession. This is assuming the Fed continues to raise interest rates. This is assuming that the situation in Ukraine with Russia gets worse and spill over. So this is discounting a lot of risk with the global macro trade, if you will. And in the bull case, notice that I'm paying about a 30% premium on the base case. This is assuming that the Fed is not going to increase interest rates anymore. This is assuming that inflation decreases. We managed to get it under control. And the situation with Ukraine and Russia gets to be settled. They come to some sort of agreement, a deal is made, and we can all resume back and focus on real problems that matter, social issues, healthcare, education, inequality gap, all of those things that really do matter, okay? So this is my bull case scenario. So with the bull case scenario, bear and base case, what would be the price target on Apple? That's the question that we're trying to answer right here. So to walk you through this, we have the base case, right? Which is flowing right through my multiples right here, okay? We're gonna take this multiple and we're gonna multiply by the expected revenue, 2022, 2023, and 2024, and that gives us an enterprise value, okay? Now we're going to adjust for cash and total debt. For those of you in the program, this is spread incomes. By now you should know how to calculate your net debt and equity value. So I'm going to calculate these figures. So I'm going to take the cash of the business, right, which I actually have it right here. Look how much cash they have on their balance sheet, $51.5 billion. In addition to that, they have long-term marketable securities. This could be bonds, CDs, stocks that they've been holding for over 12 months. However, it is still liquid. it is still considered as a form of short-term investment, but they are classifying it as long-term marketable securities, but I am going to include this. There is my cash and equivalents line. Total debt, they have $119.9 billion worth of total debt. Here is my net debt, okay? Take the net amount of those two. And here we have our equity value, taking essentially the difference. Let me just flatline my cash and total debt. We arrive to our equity value. Let's also divide the equity value by our shares outstanding, okay? And this will give us our implied price target of the stock on row 26. So with our base case using 6.1 sales multiple, okay, and using a 10% discount rate, okay, look at the price target that you end up getting. Without the discount rate, $152. That's only about 1%. The stock is actually trading there today. I mean, as of today close, Apple stock, if I minimize this, you can see where it's at. It's $153. Okay. So that scenario is already in play, perhaps. If we go out to 2024, the stock price can increase to 166. That is a 10% increase. Okay. And again, this is on the base case. And if we use a discount factor of 20%, here is the price target, right? This does not look like an attractive investment opportunity. It doesn't look like an attractive opportunity to me, right? Minimum, I'm looking for a stock where I am going to have minimum over 50% return. If it's over 100%, even better. Why? Well, the financial profile doesn't justify a higher sales multiple on the stock, okay? Let's look at scenario number 3, right? The bull case. If sales multiple is at 7.8, right? Case number 3. Okay. All right, then look at the new share price and look at the potential upside. And this could be maybe over the next 12 to 24 months. If you believe that inflation is intact and it's going to move down, if you believe that the Fed is not going to raise interest rate anymore, and the situation with Russia and Ukraine is going to get resolved, and all of the global macro problems will improve, then maybe this is the scenario. And maybe the stock will increase to $214 over the next maybe 24 months. That's a 42% upside from here, okay? On a discounted basis, that's $194. That's a 29% return. You could use a nice round number of 200 to say, well, this would be my price target if I would have bought the stock at 150. Okay. Now I compare this with the analysis performed by our own student analysts, which resulted in the high valuation, $260, right? That was her high valuation. That is the Wall Street case that she had. Her bullish case was $232 a share. Her bearish case was $185 a share. So in either case, right, I can see that the stock, all scenarios point to a higher valuation with the base case. Not so much with the base. Well, not so much with the base case. But on the bullish case, I do see, and I can justify Apple stock trading at $200 a share. If we zoom out and look at this on a 15-year basis, right, you can see that this month, each one of these bars represent a month. This is July, right? People are buying the stock. There's market participant buying the stock. So was this the bottom? Did we just experience the bottom on Apple? There's a probability that that could have been the bottom. I could make an argument that that could have been the bottom. But I can also make an argument that, no, I don't think so. I think the stock will probably move lower as well. So you could look at both sides of the equation here. But if we are objective and look at our analysis, the stock could potentially go to $200, folks. If this momentum continues to the upside, the stock could continue and move to $200 a share, giving the financial profile, Okay. And I'm just walking you through the process on how to calculate that. The question becomes, how much confidence do you have in this analysis? How much conviction do you have on placing a bet to test your own investment analysis? That's $1 million question. Okay. Now, there's a few other things here from a technical analysis standpoint that I do look at, and that is, for example, the 200-day moving average line. So let me focus on the chart right here. This is over the last 15 years, and I'll keep this very simplistic. The red line indicates the 200-day moving average line. Whenever the stock goes below the 200-day moving average line, like it did here, like it did here during the financial crisis, like it did here during global growth decline, like it did here and here, which was, this was COVID. I believe this was the whole situation with Trump 2018. But you could see that when the stock comes down under the 200-day moving average line, typically myself, I avoid it. I do not like to buy below the 200-day moving average line unless I have my DCF, unless I have my comps, unless I really know the drivers of the stock and what's happening with the company operationally and also in the industry, right? So it requires a lot more due diligence, okay? But when it comes under the 200-day moving average line, there's usually a period where it just doesn't do much, right? Just stays below there for a couple of months, like it did here. The one that was fast and furious was COVID, when we had the economy completely shut down and GDP declined for one quarter by 30%, and then it rebounded and recovered from there. But right now, it's right below the 200-day moving average line. So the prudent thing to do, at least for me, it would be to wait for the stock to come above the 200-day moving average line and give me more confirmation that it's going to move higher. That's when I would take a position. But that's me. That's based on my own risk tolerance. That's based on my own experience. And that's based on me being patient. Okay? But you want to be very cautious about this. Whenever the stock is below the 200-day moving average line, avoid. Whenever it comes right back above the 200-day moving average line, go back, do your analysis, have your price target, because this would give you perhaps a good buying opportunity for the next 24 months, like you see here, like you see here, like you see here, and like you see here, right? Look at the best performing stocks over the last decade. That's Google, Apple, Amazon. Look how they perform. And then look at the financial picture and profile of these companies. They will give you a heads up on what to expect going forward in this decade. Okay? Now, with that being said, here's what the rest of the model looked like that was performed by one of our students. And again, for those of you that are currently going through our program, this is what you're going to be doing on the internship. Here's the entire income statement, projecting the cash flows of the business for the next 10 to 9 years. Look at this, right? This is deeper level of financial modeling, okay? Here's a revenue breakdown. Here is your depreciation schedule, okay? Here you have different scenarios, and look how detailed the scenarios are. The Wall Street case, the bear case, the upside case, and then different scenarios based on trading multiples, right? Because your bear case will require a different level of valuation because you are discounting or factoring in a slowdown in earnings. Therefore, the financial profile will be perhaps bleak. It will be negative. So you're going to pay a lower multiple for the business. So you have to make your valuation dynamic. Okay. Estimates. Here's all of the list of comparables that our intern looked at to arrive to her trading multiple valuation. Okay. Here's her comps table. Here's her DCF analysis. And then finally, her football field. And here's her price target. Here's her valuation ranges. Okay. So what I performed was very basic, high-level preliminary analysis. Okay. Whereas an actual analyst would have to create all of this. And we can go even deeper into this, like looking at the entire consumer electronics space. How big is that? What is the market share of Apple? How much more market share can they gain or acquire over the next 3 to 4 years, right? What about their new markets that they've entered, right? Which is Apple Care. No, not necessarily. Which one is it? Cloud service, digital content, and payment services. These three right here. How big are each one of those markets? And what is Apple market share? And you can do a top-down analysis to estimate what their potential revenue for each one of these categories would look like over the next 5 to 10 years. Very hard to do, but that's what you're doing at the hedge fund level. And you're going very deep into all of these analysis. And you're having a much more longer term view. But of course, you can be wrong. Understanding that you can be wrong. All right, folks. So I hope this has been insightful. With that being said, I'll open it up to any questions now. So it's your time. So feel free to ask a question and I'll do my best to give you the answer. Let's see here. How do we get these numbers? Okay. So in terms of getting the numbers, you could easily go to the SEC filing, sec.gov, and pull up their quarterly or annual filings to get, historical financial information. To get estimates, typically you don't have access to that information, for free. You need to have a subscription to a Thomson One, Cap IQ, Bloomberg, FactSet. These are big financial data providers to institutional investors, and those accounts on a subscription basis easily will cost you $25,000 a year, easily, and that's just one account. So it's not that easily accessible. The best thing you can do is really understand how to perform your own due diligence, have analyst skills so that you can project what the revenue growth of the business will be. If you learn how to do this on your own, chances are that you probably won't need access to those vendors, because you can solve self-check, perform your own sanity check analysis to draw your own conclusions. Okay. Let's see. Any other questions? Okay. What is my conclusion on Apple? Well, if we go back to the analysis performed by our student, right, from 216 to 119, and then with my own preliminary analysis, on the bear case, what was it? Going out to 160, assuming that, let's say even 138 would be my floor, okay? And then on the bullish case, Apple is fairly Apple is fairly valued. If you're buying Apple, it's because you're buying their level of cash flow, and you're also buying the level of dividend that they pay, right? It's not a high growth stock. It's a mature company. Me personally, for my own risk appetite, I would not buy Apple. So it's a good company. It's trading fairly, is relatively fairly valued when you look at a DCF and trading multiple standpoint, given the financial profile of the business. But it's not something that is going to return 10x over the next 5 years. And for me personally, that's what I look for. So my conclusion on Apple, for my own risk appetite, avoid. You might be someone else that is maybe 50 or 60 years old, and you have money. You don't want to put it at risk. You want to put it on something that is stable, something that earns a dividend. Okay, then maybe Apple might fit your risk appetite. But it's not about me. It's about what's your risk appetite. What stage of your life cycle or investing life cycle are you in? The way you invest in your 20s will be very different than how you invest in your 30s. The way you invest in your 40s will be very different than how you invested in your 20s and 30s, and so forth. Okay, so I hope that kind of gives you a little bit more context into how I'm answering your question. But for my own risk appetite, I would avoid it. I would encourage you to learn how to do this, and perhaps enroll in one of our analyst programs so that you can learn how to do this on yourself, understand what's your own risk appetite, and then you make your own decision. This is really about being independent here, so that hopefully within our community, someday you can come over here on our news feed and do this, right? This is what we posted earlier this week, actually yesterday. This was on Zoom. Take a look at what I wrote, okay? We did the same analysis on Zoom. And per our student analyst, Dora, who's actually a student at Cornell, her analysis suggests that Zoom is undervalued, okay? Zoom should be trading anywhere between $200 and $123 a share. By the time that she did this, the stock was trading at $99 a share. So is there room for more upside? I think so. I believe so. But the point is, learn how to do this. And then if you're part of our community, you'll be able to see this. You'll be able to do it on your own. And then we can learn together collectively. All right. So I hope that answers your question. Okay, good. Sebastian, let's see here. What method did you follow for adjusting discount rates based on geopolitical and other? Sebastian, that's a really good question. And that's a high technical question. So if you look here at our WACC calculation, which is pretty standard, on the buy side and sell side, it's pretty straightforward, right? This is how we will calculate our WACC. You should know how to do this already from our program. However, you can add a couple of more metrics here, like country risk. And the country risk could come from the bond rating for that country, right? You could look at any one of the major rating agencies, Fitch, Moody's, and see what is the bond rating. And based on that bond rating, you can add additional points to the WACC range. I know there's an NYU professor that is very big on this formula, and that is the Modern. And the Modern looks at the country risk by looking at the bond rating, and based on the bond rating, he would assess what additional premium he would add to the company standalone WACC rate. And then you could add that country risk based on whatever other parameters that you want. I do know that some hedge funds have their own internal country risk assessment, and you would look at those, and then that would help you determine what is the WACC for that company when you take into account country risk. That's something that I'm not doing for our own analysts in our program. That's something that I don't, even myself do not look at, because I only focus on US companies. And US company, to assess the risk, I just look at the 30-year. Keep it simple, 30-year, okay? So I hope that answers your question, Sebastian, okay? And I'm pretty sure you could do a simple Google search as well to look at some examples out there. Okay, buddy? All right. All right, guys. I hope this was helpful. I hope this gives you a little bit more of the technical skill set that we apply within our program to help you do this type of analysis in our internship and improve your financial literacy. So with that being said, take care, and I'll see you on the next one, which I believe will be on AMD. All right, guys? Take care. See you in the next one. Bye-bye.